Welcome to the rules of engagement. Now, to clarify before we get into these rules and conditions that we're looking for, all of these must be present in order for you to even think of placing a trade. So just because you're in the select time window and you're aligned with all of these conditions doesn't mean you want to buy or sell. And it's not the rule set that says buy or sell, but these are the conditions that must be there for you to even look at that buy button or that sell button. So we'll be covering select time windows, salient pools of liquidity, optimal market conditions, discount pricing, and then finally our rules of engagement. So a lot of these things have been covered in our previous lectures, like salient pools of liquidity. We covered that in lecture 1 and 3. Trading below and above liquidity pools, we covered that in lecture 3, and we'll talk about this a bit more. Reversal patterns, we talked about that also. Changes in market structure, we've also talked about that, and then indication of a buy or sell program. We'll be going through this a little bit more. When I say we're looking for salient pools of liquidity, I mean we're looking for where is the likely manipulation going to be and where is price likely to draw towards. So you have to have that mapped out on your charts before you to have that framework that allows you to get into a trade and it allows you to see what price is doing. Because with those pools of liquidity that you're expecting price to draw towards for manipulation and distribution, you're able to paint the picture of what your trade is going to look like. And then trading below and above those liquidity pools. For our manipulation, when we're trading below it, we don't want it to displace below. We want it to just tap below that liquidity pool. If a few bodies close underneath and then it closes back above, that's perfectly fine. The best scenario will involve a wick and a liquidity sweep, and we'll touch on that more later. The reversal pattern ties into market structure, which we'll touch on again later. So the salient pools of liquidity, if you've watched the previous lectures, then you'll understand this. If you haven't, then you need to go and watch them, because although this may make sense to you, you're not going to know how to read these on your chart effectively. So the pre-market range, the first high and low we look at is the highest high and the lowest low of the pre-market range. Now, those will sometimes act as manipulation points, where price will trade within that range, and then during the macro, it will take the low and then trade back into the high. How far will it go? Well, sometimes it will go to daily highs and lows, or session highs and lows. So when I'm saying sessions, I'm referring to the kill zones. And the daily highs and lows, we're just using our daily candles. We're not thinking about any midnight prices. We're using settlement price. So if you go to your daily chart and you highlight all the daily highs and lows, that's what you'll get when we're referring to this. Again, kill zone high and lows or session high and lows, London kill zone, Asia kill zone, New York AM kill zone, or yesterday's kill zones. Those are things we refer to. Relatively equal highs are an amazing draw. So when we're looking for price to draw towards a higher time frame objective or just any objective, if you get relatively equal highs and those relatively equal highs happen to be those session highs and lows, then you're looking at a very likely draw on liquidity should the market give you a shift in market structure, and it indicates that it's going to switch directions and now reverse. Just because you see relatively equal highs at the Asia and London high doesn't mean price is drawing there. It means that when it switches its direction from sell program to buy program, then it's more likely to refer to that pool of liquidity. Okay, so the market conditions we want to be executing our trades in will revolve around these 5 things. So we're looking at low resistance versus high resistance conditions. Now we have a very good week upcoming for me to teach this in more lectures because we have non-farm payroll this week. And then Monday is also bank holiday where there will be no trading from me, because if the banks aren't trading, then I'm not trading because I'm aligning myself with smart money, and so should you. So you should not be trading on bank holidays. One-sided markets, this is when you're expecting price to deliver in fast way and without really facing too much pushback. We'll be talking about that more this week, and we'll be talking about all of this week because we have a very relevant week for teaching our market conditions. Economic calendar, so say we have 8:30 high impact news or 10 a.m. high impact news. Those are going to make for great silver bullet trades usually. An underlying expansion idea, so knowing where you're going to draw to on your daily and weekly chart, even on your 4-hour chart, those will allow you to align yourself with that expansion idea. So say you're bullish on your weekly chart, it's a Wednesday and you haven't made that bullish move yet, and you manipulate a low, and you're in the New York AM session, it's likely that you're going to draw towards that draw on liquidity from your higher time frame chart. Moving on to our rules of engagement. Now, these are going to be 6 rules that we cover, and they're going to go through the conditions that you require to be present in order to look at buying or selling. Just because these are there doesn't mean you enter a trade. Okay, timing, discipline. So for the London Silver Bullet, we're looking strictly at 250 to 410, and that will never change. We never extend this back and forth. We never change that time window at all. You have an hour and 20 minutes to look for that setup or to enter the trade. The setup can form slightly before 250 at 2 o'clock. As long as your entry is between 250 and 410, you're following the rules, and there is zero wiggle room here. So if you're not following that, you're not following the model and you're doing it wrong. You need to be following this. Okay, New York AM, we will never take a trade until 950. We're just reading the tape, letting the market tell us a story, and then we're looking from 950 to take trades. But even in that 950 macro, you want to let ideally at least the first half of that print off so that you can get an idea of what the algo is trying to do. Because this is going to give you those footprints, those algorithmic footprints, those signatures in price action where you can easily read it. It's obvious what price is going to do after 950. It's really obvious. If you've manipulated a low and 950 gives you those algorithmic readings and it's caused a market structure shift and there's a fair value gap entry, isn't it obvious that it's going to target those relatively equal highs that you're looking at and you're bullish on the weekly chart? Absolutely it is. Okay, and we limit ourselves to 1110 for entries. Yeah, ideally you're going to get your best entries from 1045 and prior down to 950. We can't allow ourselves to enter post that. Even though I've taught that that macro has a tendency to retrace on the move from 950 to 1050, that 1050 to 1110 macro can still be used for distribution higher if you have a very good bullish narrative. Or it can be used to engage in a late entry, and we'll be covering that in one of our future lectures. Okay, then looking at our New York PM Silver Bullet, and then looking at our New York PM Silver Bullet, we're limiting ourselves to trade from 150 to 3 o'clock. However, that time window is extendable until 4 o'clock if you're anticipating a larger price move. So if you don't get that necessary price move within that 150 to 3 o'clock, then you can extend that up till 4. However, if there is a price move and you missed it, that doesn't mean you can extend it to 4. You only extend it when there was no price move in this window. It's important not to force a trade during the New York PM, especially if you've had a large New York AM session, because after that large range AM session, you'll sometimes consolidate throughout the entire of PM, and you'll get this little fake move at the end, and that is a very dangerous move to participate in, because it can lead you to feeling more confident than you should be, and you can enter a trade and think, oh, I've been waiting for this for an hour and a half, and now we're about to get it, and then it'll just rip to your stop loss because it's a fake move. Now, that won't happen all the time, but sometimes it will. So remember, from 1:30 to 2 o'clock is the opening range. Same as New York AM. We have an opening range for the New York PM. We're looking for that opening range to tell us the story. However, entries from the 150 to 210 macro are permitted. The main thing is that you're not looking for trades before this window, or ideally after 3 o'clock. But if you don't get that price move where you've taken a pool of liquidity or you've reached into an old inefficiency, for example, then you can extend it to 4 o'clock. Say between 150 and 3 o'clock you have a price move and it's fairly large, say 60 handles, and it takes out an old high and then there's relatively equal lows, and then it becomes 320. Can you enter that trade? Yeah, you can enter that trade because the setup formed within 150 to 3 o'clock. As long as the setup forms between this time window, you're good. And then if there's no price move, then you can extend it up to 4 o'clock. Okay, manipulation event. When we're referring to manipulation, we're addressing the idea of a liquidity sweep versus a liquidity run. So if we're looking at this chart, take a second, and I'm sure you can find that there is both a liquidity sweep and a liquidity run. Down here we have a liquidity sweep, up here we've got a liquidity run. Obviously, most of us know the difference, and we've covered it in the lectures already, but the most ideal liquidity sweep is going to involve either a wick trading below that low and then the body closing above, or a candle trading through it, and then just a couple candles later we resurface back above that high or low. We resurface back above that low. That to me is a valid sign that we could potentially retrace. Does that mean I'm looking for buys already? No, it means I'm looking for some kind of market structure that's going to signify or give me the idea that we're going to keep going higher. In this case, we run through that liquidity pool with a heavy body. It's a big candle body, it displaces above and then it stays above without dropping below for quite a while. So in this situation, we would not consider that a liquidity sweep. It's a liquidity run and we're not anticipating a reversal. If you get a liquidity run, the idea of it reversing is completely out the window and you're not looking at that at all. If it reverses after and you miss a trade, doesn't matter, because the majority of the time, a liquidity run is going to result in continuation or consolidation. Okay, for our market structure shift, we're looking at a significant high that gets traded through. So in this case, we have a market structure shift over this high and that high. So these are relatively equal highs. That's a significant point of orders where we can anticipate a market structure shift. Why is this a market structure shift as opposed to this high or this high? Because A, it's far enough from price that it's not going to be traded through with just a little candle, that we can get a 10 handle up close candle and we've got a market structure shift. It has to be slightly far away like this so that it's genuinely purposeful if price trades above it. Then you want to, and we've talked about this already in the lectures, we'll be going through it even more, but for now just remember the idea that a market structure shift should have orders at it. So if we leave these highs there and then we make a fake move lower, then all of these stop losses that have been placed at this high or this high or this high, people who are trailing their stop losses very tightly are trailing them to this point. And that makes this a stronger market structure shift than this, because no one's trailing their stop loss to there realistically. Think about it. Where are they going to trail it to avoid it being super tight, but it's still tight enough where they're feeling less fear? Up here. And this isn't a valid market structure shift because it happened after a liquidity run. And now we're going to be looking at supporting displacement. So rule number 4 in our engagement list is after we get a sell side liquidity sweep, market structure shift, we want to displace through that market structure shift. So in this case, what happens? We get candle 1, not too big, candle 2, a bit bigger, and then candle 3, much bigger, and that's the candle that breaks through our market structure shift. Now that's going to be the most ideal scenario. When you can displace above a market structure shift is the best. Now think of liquidity sweeps versus liquidity runs. If you sweep that market structure shift, although it's taught as a valid market structure shift, we're still preferring that price runs above it. So in this case, when we run above and then we close below, so that wouldn't be considered a liquidity run until we get these up close candles there. So you could take an entry here, and then over here is where it qualifies as a liquidity run, because now we've traded above it for a larger period of time. And then any entry, any PDRA after this point, where we can validate this as a liquidity run, is something you could just buy on. So this order block you could buy on, this order block you could buy on. And then your TP1 would be here at equilibrium, and then eventually you target the relatively equal highs at the pre-market high. So the idea of supporting displacement is that it backs up your theory that you're going to reverse. So if you sweep that low, the first thing you're looking for is displacement to the buy side, and then a market structure shift, and then more displacement to the buy side. And then you can be really confident in your entry and take an entry like there if you have a strong draw on liquidity. So you can trade your first entry doesn't need to be on that first fair value gap. It can be on any PED array after the supporting displacement if you want. And the best form of entries are going to come here, because now you're getting that much larger risk to reward. If you're doing it here, you're getting like a 1.5 risk to reward, but it is a higher win rate. Okay, context gate. Now we have to frame all of our trades through this filter. We have to put them all through this filter where we're looking at context. So the context of the marketplace. One thing is going to be our economic calendar. Where are the high impact news events? So on Monday we don't have any, Tuesday we don't have any, Wednesday we don't have any, and then Thursday we do. So Thursday would be our most ideal entry. Doesn't mean it's not going to occur on Wednesday, Tuesday, and Monday, but the day we're looking for it the hardest and the day we're willing to take more of a chance on a trade is Thursday, because we have high impact at 8:30, and then to top it off we've also got a little bit of medium impact at 10. And then Friday, when you have core price index at 8:30, you'd also be looking for an entry. And then you also want to look at high time frames. So here we've got a 5-minute chart framing this 1-minute chart. So this 5-minute chart is just a zoomed out version of this 1-minute chart, and we're using this for context. So we have that pre-market high, we have these relatively equal highs at Asia. These are all things that you want to look at when determining draws on liquidity, when determining the story of where price should likely head to next, when determining where price should manipulate towards. And we've covered all of that in our lectures, and particularly our trading without a bias lecture, which was the most recent one. It's important to know that the economic calendar is going to have an effect on whether or not we get high resistance liquidity runs or low resistance liquidity runs. 8:30 high impact news increases our chance of having a good AM session. 10 AM high impact news usually means we'll get a great silver bullet. So if you're looking at the economic calendar, and you should be, then any day that we have 10 AM high impact news, and I realize we don't have it on this chart, but any day we have this red folder news at 10 AM is a great day to be looking for silver bullet trade. Then you want to combine that with the idea of where you're going to trade to on the higher time frame. So even if you don't have a perfect draw on liquidity on the weekly chart or the daily chart or the 4-hour chart, as long as you have somewhere that you're anticipating it is more likely to be drawing towards. So say on the weekly you're bullish, you can align these trades with the idea that you're going to start trading higher towards that objective. Now regarding low resistance liquidity runs, sometimes we'll come in and we'll get a really nice, easy, smooth run right into our target or towards our target, and then the rest fills later. Other times we're going to have high resistance days, and this upcoming week we've got a lot of good days for that to be taught because we've got non-farm payroll. So in the live streams this week, we're going to be going through low resistance liquidity run conditions and high resistance liquidity run conditions. Now, those are very important because it will determine how much size you want to put in. It'll determine how much more likely you are to enter with less confluence. And we'll be going through all of that in our lectures this week. And then the next thing we're looking at, or the last rule, is that we want to have predefined management. So refer to lecture 3, where we had trading without a bias. That lecture, we said many times we require this to happen, and then this to happen, and then this to happen, and then that would be an entry. And although it didn't happen, that's what protected us from getting in on a trade early, because we knew that we would want to see a fair value gap and then an inversion of a 5-minute fair value gap in order to enter that trade. And this isn't that trade, but having that predefined entry criteria where you're saying to yourself, okay, I require this to happen, and then I require that to happen, and then I require this to happen, and then I can click the button. That protects you from overtrading and over leveraging, because now you're filtering everything, every single trade idea through that little criteria that you need to meet, these rules of engagement, and then the entry criteria as well. So if you're saying, I want that inversion fair value gap to be, I want this fair value gap to become an inversion fair value gap and then trade back into it before we enter, that would be a potential entry point, and you would have hit take profit because you're giving yourself that trade plan, even if it's subconsciously now, where you say to yourself in your head, I want the market structure shift. I want the inversion of that fair value gap, and then I can enter. And then how you manage your stop loss will be covered in the upcoming week as well, if we can get any good trades. And then how we manage our take profits will also be covered in our next video in the upcoming lectures. Okay, the final thing I want to go through is that all of these rules of engagement need to be present for you to even look at that buy button. Don't think that you can ignore any of these things here, because if you do and the trade delivers, then A, that's a mistake, and that's a worse mistake than if it didn't deliver, because you hitting a good trade without these engagement rules is going to lead to you thinking that you can get away with not following this list, and you absolutely cannot. This rule set I'm giving you isn't the be-all end-all list, but every single chart you look at in terms of a silver bullet, if you want to be getting into a trade, it absolutely needs to meet every single requirement I've outlined here. All of them. Because you're putting money on the line. You cannot be entering on a whim. Just because you see a market structure shift and it retraces into a fair value gap doesn't mean you can go ahead and place that trade. You need to be following every single rule here. Do you think I just see a pattern, put my money into the market? No. Because money is important to me, and I'm not a gambler that I'm gonna see one little pattern and flip on every single thing that's happened in the session. Because remember, we're trading a reversal. It's hard to trade a reversal. With what I'm giving you here, it isn't. If you're following this and every single thing is present, it's easy. It's very easy. So follow the list, write it down. Don't think you can get away with not doing it, because you can't. I've learned this from years of experience and years of messing up and doing it wrong. So trust me, I know better. Okay, but that is it for the video, and we'll be doing our weekly outlook tomorrow, because tomorrow's a bank holiday. I want to let the bank holiday play out, and then I'll do the weekly outlook after Monday is already finished. And then we'll be doing live streams every single day after that. So there's not going to be a live stream on Monday because of the bank holiday. There's just no point trading a bank holiday because the banks aren't trading, and why are you going to be trading? And then we'll be doing a live stream on Tuesday, Wednesday, Thursday, and Friday, and it is non-farm payroll week, so we're going to have a very interesting week, and I look forward to seeing you all in the live streams. Thank you for watching.